Welcome back to Drift Shield, your primary destination for clear and reliable automotive finance insights. Today, we are exploring a financial tool that keeps thousands of drivers safe from unexpected debt every year. Buying a new car is an exciting experience, but the financial reality behind vehicle ownership can quickly catch you unprepared. When you drive a brand new vehicle off the dealership lot, its market value drops instantly through a process known as depreciation. If an accident happens during those first few years of financing, standard auto insurance might not cover everything you owe to your lender. That specific gap between what your insurance pays and what your loan balance remains is where specialized protection comes into play. To understand why this coverage is necessary, you first need to examine how standard auto insurance handles total loss claims. When your vehicle is severely damaged in a crash or stolen without recovery, your primary insurance provider steps in to evaluate the loss. However, insurance companies do not base their payouts on what you originally paid for the vehicle or what remains on your loan. Instead, they calculate the actual cash value of the car at the exact moment right before the incident occurred. Actual cash value factors in age, mileage, wear and tear, along with local market conditions. Because cars lose value so rapidly, that final valuation figure is almost always significantly lower than your original purchase price. Depreciation is the continuous decline in a vehicle's monetary worth over time due to normal usage and market forces. Most brand new vehicles lose approximately 20% of their original value within the very first year of ownership. Over the course of 5 years, a typical car can lose up to 60% or more of its starting sticker price. Meanwhile, your auto loan balance decreases at a much slower pace, especially during the early stages of your payment term. During those first few years, your monthly payments mostly go toward paying off interest rather than reducing the principal loan balance. This creates a dangerous period where you owe far more on the loan than the physical car is actually worth. Financial experts often refer to this specific situation as being underwater or upside down on your auto loan. Being upside down is not an immediate problem as long as you keep making your monthly payments and keep driving the car. The real danger arises when an unforeseen event occurs, such as a major accident or severe weather damage. If the insurance company declares your car a total loss, they will only write a check for its current actual cash value. You remain legally responsible for paying off the remaining balance on your auto loan, regardless of whether the car is drivable. Without extra financial protection, you would have to pay thousands of dollars out of your own pocket for a car you no longer own. Guaranteed asset protection, which most people simply call gap coverage, was created specifically to eliminate this exact financial vulnerability. This specialized product covers the specific difference between the actual cash value payout from your primary insurer and the remaining balance on your loan. For example, if your lender balance is $25,000, but your car is valued at $20,000, gap coverage pays the remaining $5,000. Without this policy, your primary insurer hands $20,000 directly to your lender, leaving you personally responsible for the remaining $5,000. Gap protection steps in to settle that leftover deficit, so you do not suffer a sudden financial burden. It is equally important to understand what gap policies do not cover so you can manage your expectations correctly. Gap protection does not pay for physical repairs to your vehicle after a minor fender bender or routine accident. It does not cover overdue loan payments, late fees, or financial penalties accrued before the total loss occurred. Additionally, it will not pay for extended warranties, credit insurance, or extra security packages that were added into your original loan financing. Gap coverage triggers only when a vehicle is declared a total loss by your primary auto insurance provider. Understanding these clear boundaries helps you build a complete insurance strategy without assuming full security. Certain buying scenarios make gap protection almost essential for responsible car buyers and lessees. If you make a small down payment or no down payment at all when purchasing a vehicle, you start your loan deep underwater. Financing a car over an extended timeline, such as 60, 72, or 84 months, also increases your risk significantly. Leasing a vehicle is another situation where gap protection is mandatory, though many lease agreements automatically include it. Additionally, if you roll negative equity from an older car loan into your new financing agreement, your deficit increases immediately. In all these instances, gap coverage acts as a crucial safety net for your personal finances. Vehicle selection also plays a major role in determining how fast your loan value separates from market reality. Certain automobile makes and models suffer from much faster rates of depreciation than others across the market. Luxury sedans, electric vehicles, and high-end SUVs often lose value at a much steeper curve than compact commuter cars or popular trucks. If you finance a model known for rapid depreciation, your risk of being severely underwater increases within the first 2 years. Researching historical depreciation rates for your desired vehicle helps you determine whether gap protection is a wise purchase. Matching your insurance coverage to your vehicle's specific value trajectory saves you from unexpected financial surprises down the road. When you decide to obtain gap protection, you generally have a few distinct avenues available for purchase. Auto dealerships routinely offer gap protection in the finance office when you complete your vehicle purchase paperwork. Financial institutions, including banks and credit unions where you secure your auto loan, frequently sell this coverage as well. Lastly, major auto insurance providers offer gap coverage as an optional add-on rider to your existing car insurance policy. Each option comes with different pricing structures, payment methods, and terms that you should evaluate carefully before signing. Taking the time to compare these options ensures you get the best protection at a fair market price. Purchasing gap coverage directly from a car dealership is often the most convenient route, but it can also be the most expensive. Dealerships frequently charge a flat fee ranging anywhere from $500 to $1,000 for a full gap policy. When you buy through the dealer, this fee is usually rolled directly into your total auto financing package. While this means you do not have to pay upfront, you will end up paying interest on that fee over the lifetime of your loan. That interest accrual increases the total amount you spend on the policy over several years. Knowing this cost structure helps you evaluate whether buying at the dealership fits your long-term budget goals. Obtaining gap coverage through your primary auto insurance company is often the most cost-effective alternative available. Insurance providers usually charge an annual premium that adds only a few dollars per month to your standard policy bill. Over the course of 3 years, adding gap coverage to your existing auto insurance might cost less than $200 in total. This method allows you to remove the coverage as soon as your loan balance drops below the car's actual cash value. However, some insurance companies require you to carry both comprehensive and collision coverage to qualify for this add-on feature. Checking with your insurer beforehand gives you a clear picture of potential savings. Credit unions and traditional banks provide another competitive middle ground for purchasing gap coverage on financed vehicles. Financial institutions usually sell gap protection for a reasonable one-time flat rate that is significantly lower than dealership prices. Many credit unions also include extra benefits with their gap policies, such as assistance toward your next vehicle purchase. Because banks specialize in loan structures, their representative can explain exactly how gap coverage interacts with your amortization schedule. Buying through your lending institution keeps your coverage tied directly to your financing without adding excessive interest charges. Comparing bank offers alongside insurance quotes empowers you to make an informed financial decision. Timing is a critical factor when deciding whether to add gap coverage to your auto loan. Most insurance companies require you to purchase gap protection within a specific window after buying a new or used vehicle. Dealerships and lenders typically require you to enroll at the exact time the financing contract is finalized and signed. If you wait several months or years after taking delivery of the car, securing gap coverage becomes much harder or entirely unavailable. Furthermore, the risk of being underwater is highest during the first 24 months of vehicle ownership. Securing your policy right at the beginning ensures you remain protected during the most vulnerable period of your loan term. You do not need to keep gap coverage for the entire duration of your auto loan term. As you make monthly payments, your principal balance decreases while the rate of depreciation on your vehicle eventually slows down. At a certain point in your loan timeline, the actual cash value of your car will exceed the remaining loan amount. Once you reach positive equity, gap coverage no longer serves a practical purpose because there is no gap to cover. Monitoring your vehicle's market value regularly allows you to identify when you cross this equity threshold. Canceling the policy at that moment prevents you from paying for coverage you no longer require. Calculating whether you still need gap coverage involves a straightforward comparison of your loan balance and vehicle value. You can check your current remaining loan principal by logging into your lender account or reviewing your monthly statement. To estimate your car's actual cash value, consult reputable valuation resources like Kelley Blue Book or Edmunds. Input your exact mileage, current vehicle condition, location, and installed options to get an accurate market range. Subtract your estimated vehicle value from your current loan payoff balance to see if a gap still exists. If the resulting number is 0 or negative, you can safely contact your provider to cancel the policy. If you cancel a standalone gap policy early, you might even be eligible for a partial refund on the unused portion. When you pay for a full gap policy upfront or finance it through your dealership loan, the fee covers a set period. If you pay off your auto loan early, sell the car, or refinance, you can request a prorated refund for the remaining months. You will need to provide your gap provider with proof of loan payoff or vehicle sale to process the cancellation request. Many drivers forget to claim this refund, leaving money on the table when changing cars or paying off debts early. Taking this extra administrative step puts cash back in your pocket where it belongs. Refinancing your auto loan is another situation where you must reevaluate your gap protection strategy carefully. When you refinance a car loan with a new lender, your original gap policy usually terminates automatically along with the old loan. If you are still underwater on the vehicle after refinancing, you will need to purchase a new gap policy for the new agreement. Some drivers accidentally assume their original gap protection transfers over to the new financial institution without any hassle. Always read the terms of your refinancing contract and verify coverage status with your new lender. Staying proactive during a loan refinance prevents dangerous lapses in your financial protection. It is also essential to distinguish gap coverage from other auto finance products like replacement cost insurance or loan payoff protection. New car replacement insurance pays to replace your totaled vehicle with a brand new model of the same make and year. Loan payoff protection specifically handles your remaining auto debt if you experience unexpected disability or job loss during the loan term. Gap insurance focuses strictly on the difference between actual cash value and remaining loan principal after a total physical loss. Understanding these distinctions ensures you do not buy redundant policies while missing out on the exact coverage you truly need. Selecting the correct financial safeguards gives you full confidence while driving on the open road. Real-world scenarios demonstrate how gap coverage prevents unexpected financial hardship for average drivers facing total vehicle loss. Imagine buying a $30,000 sedan with $500 down and financing the rest over 60 months. 2 years into ownership, an uninsured driver runs a red light and completely totals your vehicle in a collision. Your insurance determines the actual cash value is $18,000, but your loan payoff balance stands at $22,000. Without gap coverage, you must pay $4,000 out of pocket to clear the debt on a car you cannot drive. With gap protection, that $4,000 balance is wiped out entirely, leaving your budget completely intact. Thanks for watching the video on Drift Shield, and we hope this breakdown helped you understand how gap coverage protects your finances. Subscribe this channel for more clear automotive finance advice, and like the video if you found the video great. If you have any questions, leave me your comment through the comment section down below so we can keep the conversation going. Making smart insurance decisions keeps your hard-earned money safe while allowing you to enjoy your vehicle with total peace of mind. Drive safely, stay informed on your auto finances, and we look forward to seeing you in our next video.